those who invest in gold and silver have done no due diligence on Bitcoin. If America is this big superpower of oil production, why are we drawing down our strategic petroleum reserves? Basically, zero uranium production happening in the United States right now.
Welcome, everyone. I'm your host, Tiger Stacker, and today I'm happy to welcome back Jesse Day from Commodity Culture. He's had some really great interviews on his channel, and I recommend you go watch them. Please keep in mind, we are not financial advisors, and this is not financial advice. Do your own due diligence and look into where you're going to invest your hard-earned money. So I'm not going to give you a long introduction because he's been here a few times. So without further ado, I want you to welcome my guest, Jesse Day. Welcome back to the channel, Jesse.
Great to be back, Tiger. Always enjoy our conversations, and hopefully we can dive into some topics that'll be useful to the viewers.
You always have been. I've gotten some great feedback from people when we've had our previous interviews.
That's awesome.
It's been a while since we last had you on the channel. Since then, you had a major new development on your channel. And for the very first time, you introduced something called your first boot camp. And I get the feeling that this will be the first of many. I'm sure many of us in the stacking community have not seen it. Can you please tell us about your boot camp, the material contained in it, how well did it go, and can those of us who did not see it be able to go back and watch it?
Yeah, it went really well. It was a deep dive into my own, basically, view, the lens through which I view investing in the commodities sector. So we went over my own personal portfolio, pretty much all the companies in it, everything I hold, why I hold it, as well as just my overall framework for how I see the commodities sector evolving moving forward over the next several years, why I think commodities are the place to be positioned over the course of the next, let's say, 2 to 10 years, and basically honed in on gold and silver, uranium, oil and gas, talked a little bit about agriculture, and I hit the target for attendance that I was setting out to get, so very excited there. And in terms of other people being able to watch it, you can go to join.jesseday.ca and you can order the replay and you can watch it. It's about it's 2 hours in length total, about an hour and a half where I discuss my portfolio and my thesis for commodities, and then the last 30 minutes was a Q&A with the audience.
I'm assuming there's a small price attached to it.
It's not a small price. It's the same price as everybody paid to watch it originally, because actually several of the people who signed up weren't able to attend. They signed up just to watch the replay after. So I'm not providing a discount on the replay. It's the original price, which I think is $67 US.
Okay. That's not that bad.
I think it's worth it, to be honest. I'm a little biased, but everybody who attended got really good value out of it. I got a lot of good feedback. And I think for those who were willing to dive a little bit deeper into commodities and kind of go beneath the surface thesis and look to pick their own stocks and kind of develop their own outlook on the sector, that was a big focus of what that webinar was about.
Well, if you look at things and you're trying to build on your wealth as well as just straight metals, $60 is not that much. You know, when I go away to medical conferences, it costs me a lot more than that. And that doesn't include travel and hotel and all that. So that's not so bad.
And there should be another one coming. So at some point, we're going to do another event. Maybe we're going to hone in on a specific commodity in the next event, like a purely uranium-focused boot camp. So definitely people can stay tuned for that as well.
Many in the community might not know that you're a stacker, but you also diversify into other avenues. If I remember correctly, you said you were doing better than the S&P 500. Correct me if I'm wrong. Would you care to tell us your approach on precious metals and where you stand in our current situation globally?
Absolutely. Yes, I have outperformed the S&P 500 since my portfolio's inception in September of 2020 until today. So we're almost at 6 years. And I've outperformed the S&P on an annual basis using time-weighted returns of about 4.6%. There is a single-digit percentage of actively managed funds in the world that achieve that type of return. I'm talking about funds being run by people from Ivy League schools and stuff like that. So as a retail investor, to outperform the S&P on a per annum basis over a 5+ year time frame by that amount is kind of unheard of. So I'll throw that out there. Yeah, so my strategy, of course, the very first investment I made in my portfolio in September of 2020, when the whole thing started, was 10 ounces of silver. So that was my base, the very first thing I started with. And so I believe that physical precious metals are really the foundation of any portfolio because they're insurance. They're your insurance policy. Before you look to capital appreciation, you should look to capital preservation. And gold and silver historically have fulfilled their role as a hedge against inflation, as a preserver of purchasing power, as protection against government malfeasance, against the central bankers' money printing policies, and all the rest of it. You have to have some amount of physical metals, in my opinion, before you start speculating in the mining sector and those sorts of areas. So my approach begins with physical precious metals and then, of course, into miners. So when it comes to the precious metals specifically, I'm not much of an expert on the evaluating individual miners. So I think that's one important thing, is to know your strengths and weaknesses. I don't understand gold deposits and silver deposits and how they're mined and stuff like that. So I focus on what Rick Rule calls the beta of the sector, meaning the biggest and the best. So I don't go into the weeds looking for small explorers who are maybe going to 10x. I don't care about 10 baggers. I have no interest in them. I leave the 10 baggers to others, to people who are experts on geology. I'm looking to make a solid 2 to 3x return on my investments and then roll that over into another investment that's going to generate 2 to 3x. And as one does that over a lifetime of investing, that capital ends up compounding into rather large numbers if you're able to consistently do that. So I'd rather consistently hit base hits and focus on that than try to swing for the fences and hit a home run here or there. So that's kind of my approach. So when it comes to precious metals miners, I look to the royalty streaming space. Wheaton Precious Metals is one of my biggest positions. Agnico Eagle, which is one of the biggest and the best gold mining companies in the world. I like the ETFs. I have some GDXJ and some SILJ to get a little more torque there from the junior sector while remaining diversified. And so when it comes to gold and silver, aside from the metals, that's my approach to the miners. And then, of course, the rest of my portfolio is mostly commodities based. I've got some uranium miners is a big part of my portfolio. Gold, silver, and the gold and silver miners are the biggest portion of my portfolio when it comes to commodities. Then uranium and uranium miners, then oil and gas. Then I have some agriculture exposure as well, a little bit of emerging markets. And actually I have Bitcoin as well because I started stacking sats, as they say in the community, pretty early. Silver was the first thing I ever invested in. Bitcoin was the second. So that's actually grown into a fairly large part of my portfolio, but that's because of the appreciation. I had a goal to hit a certain target of how much Bitcoin I wanted. I'm there. I'm not investing in any more Bitcoin. I mean, unless something crazy happens, I've got enough, but it's appreciated quite a bit. So I was buying Bitcoin when I believed it was very undervalued. Maybe that day will come again. That's also driven some of my portfolio performance as well. I don't talk about it on my show. I talked about it in the webinar actually, but I don't talk about it on my show because everybody who watches my show hates Bitcoin for the most part. Most gold and silver stackers, for some reason, they hate Bitcoin. They think it's this evil thing. I think there's misunderstandings on both sides. I think very often there's these arguments that break out on social media. Generally speaking, those who invest in gold and silver have done no due diligence on Bitcoin, and the Bitcoin maxis have done no due diligence on physical gold and silver. And so they end up just yelling at each other like two ships passing in the night. Neither of them understands the other's asset, and yet they're locked in this kind of eternal war over whose asset is better. I think Bitcoin and precious metals are complementary assets, not competitive. You can hold both. That's the approach that I take, and that's kind of a snapshot, I guess, of my overall portfolio.
That's good to know. And it does take a lot of energy to monitor these, especially if you're doing it by yourself.
Yeah, absolutely. I would just interject quickly to that comment that watching day-to-day price action is usually detrimental to most people's psychological health. And that's one of the factors that I touched on in the webinar, is that, volatility is the price you pay for performance. I believe it's Peter Lynch who said that originally. And nowhere is that more true than in the commodities sector. So when you get outside of just the precious metals physical and you start investing in miners, you're going to see large price swings, both to the upside and the downside. So you really have to be able to keep a calm mind in all situations. Don't go celebrating early because something went up a lot, and don't go despairing and selling everything because it dropped a certain amount. You have to, as long as you really understand the underlying thesis of what you hold, which is really important, which is why due diligence is so important. You look at day-to-day price action more as entertainment than as an indication. And what you're looking for is performance over time. 5 years, you can start measuring your performance at a year, but it's not that you don't get enough data. 3 years, you're starting to get some data. Once you get to 5 years, you can take a step back and figure out what worked, what didn't, and how you want to maybe pivot your approach from there.
This channel is affiliated with ARC Silver Gold Osmium. The owner, Ian Everard, is one of the most honest bullion dealers in the United States. ARC Silver Gold Osmium's owner, Ian, advertises new stackers to start their portfolio in the exact order he named his company. First, starting with a base of silver, then based upon the individual's plans and abilities, progressing to gold. Although he is the first dealer of osmium in the United States, he recognizes that osmium is not for every stacker or collector, and he does not advise this for everyone, but it is there for the stacker or collector who is interested in additional metals, including osmium, platinum, palladium, and others. ARC Silver Gold Osmium has some of the best prices that you can see here and on his website, noted in the QR code and in the description below. You can also call for pricing and purchasing and take advantage of his specials today by reaching out to Ian at 307-264-9441 or by email at ian@arcsgo.com. And make sure to tell him, of course, that Tiger Stacker sent you. You also get into other commodities, including oil and gas, as well as stocks and, like you said, ETFs. This is one of the reasons I would like people to go to your boot camp and your channel so they can learn how to potentially find ways that will work for them. Would you care to elaborate?
Yeah, so I'm heavy on commodities, more heavy than probably most people should be. So it goes to the strategy is, as Rick Rule, I'm going to bring him up again because he gives out a lot of interesting information. He talks about you don't want to hold more individual companies than hours in a month that you have to keep up to date with them. That is something that I found to be very true. You don't want to have this massive portfolio of all these different stocks because that's the approach some people take. Unfortunately, that's a losing approach in my opinion because, you hear about this company and that seems good. So you buy some of that, then some of this, then some of that. Next thing you know, you got like 60 stocks in your portfolio. The year goes by and you don't even know what's happening at any of these companies. Half of them could be going in the wrong direction. You should have sold. So as much as I say, don't track day-to-day performance, you do need to track the companies that you hold on like at least a quarterly basis. All the companies issue quarterly earnings reports. You need to make sure you're up to date on those. They do conference calls. You need to be listening to those. And you need to make sure that thesis that caused you to invest in the beginning is still intact. And it really depends on how much time you have to research the various commodities and form your own thesis, because it does take time. And this is another question that's come up to me, like, why don't you invest in copper? Why don't you invest in nickel? There's all sorts of other commodities. I'm only focused on what I'm focused on, which is gold, silver, uranium, oil and gas, to a lesser extent agriculture. That's it. A little bit of emerging markets exposure through ETFs, because I don't have the time to now start looking into the copper thesis. That's like a whole other, I'm sure it's very bullish. I've heard lots of great things. I have many guests on my show who are very bullish. From what I've seen, copper's set up to do very well over the same time frame that I'm tracking, but I just don't want to put something extra on my plate that then distracts me from paying attention to the oil and gas space, for example. So I think if you want to diversify outside the precious metals, for those of us who are stackers and are maybe first looking to get some exposure to the mining sector, then you could stick with gold and silver, and I would recommend taking that Rick Rule beta approach. Just get the GDX ETF and the SIL ETF, which are the two big ETFs that hold a basket of miners. You'll probably do fine. Not investment advice, but for most people, just getting their feet wet, that's probably the correct approach. And then if you want to expand outside and look into things like uranium, oil and gas, gas, agriculture, etc., you need to make sure you take the time to research the thesis, figure out what could go wrong, what could cause, that's important as well to figure out what the negative case is where at what point will you admit your thesis is wrong? This is an important kind of litmus test to have so that you're not, because it's very easy to get bullish about a lot of these things and then we just stay bullish no matter what because people become emotionally attached to what they're holding. And investing in a company is very different from holding physical gold and silver. Physical gold and silver is free of counterparty risk. It's a metal that has proven to be a monetary metal for 5,000 years plus. The track record is there. You're holding your wealth in your own possession. You can essentially hold forever because it is wealth. So you don't need to worry too much about price fluctuations. With mining companies, commodities production is very cyclical. So you have up cycles and you have down cycles that are often based on when prices get too high, ultimately demand will fall. And when prices get too low, the opposite happens. And so you have to be watching the cycles, be aware of them, and also be acutely aware of the thesis behind the commodity you're investing in. What's bullish, what could be bearish up ahead, and then keep track of it. So there's definitely some time that needs to be put into it, but focusing on the long-term game, I think, is key.
Recently, you've had Jim Rickards on your channel, and he said something that made a lot of sense to me. I was wondering how in the world petroleum prices can increase if we are selling a lot of hours and we've had increase in our production. He basically said on your channel that it's because despite the increase of production of this country and other countries, we are not making up for the 20% deficit not coming out of the Strait of Hormuz. What's your take on this?
I would say without the Strait of Hormuz, the world still wasn't producing enough oil and gas. Oil specifically, I guess I'll stick to here. So the Strait of Hormuz debacle, in my opinion, highlighted a structural weakness that already existed in oil markets. It was a geopolitical event, and I caution people against trading around geopolitical events. For example, those who jumped into oil when this whole thing kicked off are now kind of probably back to where they started in terms of the price, because oil went from mid-50s, early 60s up to over 100, 110s, somewhere in there. And now we're sitting around $68 a barrel. So it's still elevated from pre-Hormuz crisis. But I think Rickards is correct that there's already a supply shortfall worldwide. Oil's being hated. It's being divested of by all these large funds, used to hold oil stocks. They sold them off for ESG reasons. Now that's starting to shift. That paradigm is starting to shift a little bit. I think we're starting to see some of these big institutions look at the space again. But the years of underinvestment are so severe. And, you mentioned America being an energy superpower, and it is. It's the world's largest producer, I believe, as of the most recent data, massive oil exporter. However, the shale oil fields, which caused a lot of the whole shale oil revolution and caused the US to become an energy superpower. There's a lot of data indicating that production in those fields is starting to roll over in the Eagle Ford, the Bakken, and the Permian Basin. Those are the big ones. And if that data is correct, and it's being put together by some very smart people, including Lee Gehring and Adam Rosenzweig at Gehring and Rosenzweig, I recommend people look into their work. But it's not just them. Many people have observed this. We're starting to see the fields roll over. When these fields roll over, production draws down at a much faster pace than it accelerated at when you started to bring these fields online. Just the production curve for an oil field is not like up gradually, then down gradually. It's up gradually, and then it falls off a cliff once production starts to become exhausted. And so we're already seeing situations in these major shale oil fields where the cost of extracting a barrel of oil is going up significantly. Places where perhaps it used to cost $30, $30, $40 was your break-even price. Now we're getting into 50, 60 plus 70 in some places. And so it's getting more expensive to extract, meaning that you're going to need a more sustained higher oil price for those fields to produce. It's a simple question of economics. And now the other thing is perhaps where I would not disagree with Jim Rickards, but and I think he brought this up actually. It was the petroleum reserve. the United States petroleum reserve has been drawn down to levels not seen since the 1980s. So if America is this big superpower of oil production, why are we drawing down our strategic petroleum reserves to the lowest level since the 1980s? That's insane. That's dangerous in many senses. This is supposed to be a reserve of petroleum for crises and emergencies. And I guess you could consider this one, but it underlies the fact that, okay, yes, the US is producing a lot of oil, but clearly not enough for this type of situation because it's having to go into its own strategic reserves to try to keep gasoline prices down and all of these things. Because, of course, we have the midterm elections coming up. And most people, you can talk about ideology, left versus right, but most people vote with their wallets based on how they perceive the economy is doing, and they blame whoever is in office right now. So if we see these sustained higher prices at the pump of gasoline, then you're going to have people decide, well, I'm going to vote for the other party then, right? And so you have a problem at midterm elections. So there's a lot going on. Oil's very difficult to track because geopolitics plays so much of a role, but you don't want to bet on geopolitical events. So that's why when the conflict kicked off and the oil price started going up, I did not deploy any more capital. I did not invest more. I just sat on the sidelines, which I'm still doing, because for me, these types of geopolitical shocks are usually temporary. I see the long-term trajectory for the oil price being higher, going to the upper right of your screen over the course of the next 2, 3, 4, 5+ years. But patience, I think, is key there. Finding your entry points, and perhaps coming up, we'll see a good entry point for the sector as people kind of start to believe, well, the whole thing in the Strait of Hormuz is fine. Everything's going to go back to normal, which I don't think is the case. And a lot of people don't see the underlying supply-demand imbalance that was there before the Strait of Hormuz kicked off. There's a lot of people who are new to the party and think, oh, oil's back down, it's over. But I think it will be proven. I think we will see triple-digit oil prices again within the next few years. And so perhaps coming up soon could be a good time to get positioned in that sector.
Being that this is mainly a precious metal stacking channel, we've seen a lot of volatility. Major price hike in January, we're approximately plus or minus half of that in silver. Gold has had some volatility, but it's never as volatile as silver. And being that you started off in physical metals, what's your take on this? Do you think, in your opinion, do you think we're going to be having more price reduction? Or is this your typical summer lull with it possibly going up after the summer comes and goes?
Yeah, it's a great question. It's what a lot of people out there are concerned with. I think physical silver is at a good price right now. If somebody was looking to enter the space and maybe pick up their first coin or their first 10-ounce bar or something like that, I think this is as good as an entry point as any. And could the price go down more? Yeah, of course it could. But I think what that spike to intraday, it went to 120. I believe the highest it closed at was 116, something like that. What that showed us was that the supply demand imbalance is very real. We're in our 6th consecutive year of a silver supply deficit, according to the Silver Institute. And I think what that moment in time told us when silver surged that far, that fast, is that, you have the paper market, which is a lot of speculation, futures trading, etc. And you have the physical market, which is priced in reality, the reality of the physical supply and demand. I don't think we've gotten anywhere near the true value of silver being reflected on the ticker, but I think that we will see triple-digit silver again. It's a matter of time. These things are very hard to predict, obviously, but I think we could see further downside. It would surprise me if it went back below 50. I think anything's possible, but I think 50 is kind of potentially the new floor. And then when it comes to gold, I picked up some silver recently. I'm waiting on gold. I'm looking for a $3,500 price before I potentially add to the gold stack. I think that would be a great entry point. And I do foresee, Jim Rickards, as you mentioned him earlier, he predicts we could see gold at 10,000 by the end of this year, early next year. I think anything's possible. I look at the long game, and I also don't buy gold or silver to make money. I buy them more as a capital preservation tool. But I think we will see gold get to the $6,000 plus range. Maybe that's conservative to some people, but slow and steady wins the race. That can often be the difference between gold and silver. You can see silver really take off, but the downside of that is that usually it takes off too fast, too far, in too short of a time. And so you get selling on the other end. You get sort of a collapse of the prices we've seen. But I mean, you have to take things into perspective. Consider it was last year where people were talking about how crazy $50 silver was. I can't tell you how many comments I got on my channel whenever a guest brought up $50 silver when it was in the 20s and 30s. And the comments filled with people saying, this guy's an idiot. Silver's never going to break 30 again, blah, blah, blah. And I mean, and we went to 120 intraday. So perspective is necessary. If you went back in time to the beginning of last year and you told people silver's going to be over $50, people would be ecstatic. They'd be celebrating, right? But because it ran to 100 plus, and maybe some people got burned jumping in at those triple digit numbers, now people are despondent and they're negative about the sector. So I think perspective is important. I think both metals are just going higher because it's the backdrop of government malfeasance, massive debt and deficits, money printing, some of the most corrupt governments around the world that I think we've seen in modern history, insider trading, extortion, racketeering, money laundering. The governments are doing this out in the open at this point. I think it's a loot the system moment. I think a lot of them realize that the system we're under is not sustainable. And so they're grabbing everything they can before the whole thing collapses. I think that scenario means you want to be holding gold and silver.
I can never agree enough with holding the physical. There is another yellow metal that we both love to talk about, but it's dangerous for us to physically hold. That metal is uranium. You seem to understand it extremely well. I've dabbled a little bit in mining stocks in uranium, and uranium has always done better than the rest of the other mining stocks that I have dabbled in. And in most recent days, all the mining stocks have gone down, so has uranium, but despite the rest of them has remained at a higher level and hasn't dropped as much. What's your take on the current market in uranium compared to the other stocks, especially the metal stocks?
Yeah, I've been a buyer. I bought some uranium stocks a couple days ago. I added to the position because, like you said, there's been a pullback recently and the fundamentals underlying the sector are just so unbelievably strong. I think it's a buying opportunity. And now the interesting thing about uranium, you mentioned you can't hold the physical, and that's true, but you can hold a representation of the physical through the Sprott Physical Uranium Trust. They store physical uranium in warehouses. It's an ETF. That's the lowest risk way to get, if you just believe the price of uranium is going up and you've studied the underlying fundamentals, that's kind of the lowest risk way to get access to the sector because you're literally just betting on the price of uranium itself. You don't have the risk of mining is very hard. All sorts of issues crop up when you're a miner. So that's probably the safest bet in the sector. And obviously you're not going to get 10x returns out of it, but you could get a steady 2 to 3x as I kind of outlined when I was talking about my thesis. I think uranium's in one of the best places it's ever been. I believe the highest long-term contracting price ever was reported recently at about $95, $96 a pound. I think that now, the tough thing about uranium is the pricing mechanisms are broken. So you have a spot price, which is the most frequently updated. The spot market accounts for only 20%, 25% of annual transacted volumes on a good year. Usually it's less than that. A lot of it's traders flipping pounds to make a few bucks a pound. It's a very illiquid market, very few people participating in it. But because it's the most frequently updated, that's the number that investors look at. The long-term contracting price is more accurate of the long-term trajectory, but it's also it's not real. So I just said that the long-term contracting price has reached the highest ever. Well, the problem with long-term contracts is in the uranium sector, many, if not most of them, I believe it's most of them, come with non-disclosure agreements attached to them. So the parties aren't allowed to discuss the price that the uranium was transacted at. So you have to gather the long-term data from those contracts that do not have NDAs or from those that do have NDAs around the exact pricing, but they give a vague number like around this, the floor and ceiling prices are around this level. So then you kind of have to make your best guess. So even the long-term contracting price is opaque and can't 100% be relied on. So that means the fundamentals are much more important than just watching the price. And, the fundamentals are incredible because not only is the demand going up, the supply side constraint is becoming worse and worse. The world's biggest uranium miner, Kazatomprom, has had all sorts of issues. They traditionally only produce a third of the world's uranium, and they've had sulfuric acid shortages. They've had to cut production guidance. Also, they're selling tons of their product to India now, as well as China, Russia. So they're kind of wedded to the East when it comes to this new geopolitical reality we're living in of a bifurcated world. So a lot of that production's taken away from the West. Cameco, one of the other big producers, Canada's having issues. I believe Orano, which is one of the largest, a French company, also having issues with production. And those are the only three. I mean, you got Rio Tinto that does a lot of commodities. They have uranium as well. But when it comes to pure play uranium companies, Kazatomprom, Orano, Cameco are the three biggest in the world by far. They're the only companies producing uranium in any sizable quantity. And all three are having problems with production, meeting production guidance. Then you have developers who are trying to ramp into production. These are companies that they have a resource. They've done some economic assessment to, get the general idea of how economically viable it is to extract the resource. And they're moving towards building the mine. Now, they're facing all sorts of problems too. Global Atomic in Niger, there was a coup. They can't get any financing because no one wants to finance a mine in such a geopolitically shaky part of the world after a military coup took place. You have Encore Energy in the US with problems, Boss Energy in Australia with problems. The list goes on of these developers trying to get into production who are having issues doing so. And in the United States is an interesting story because 20% around of all the US's electricity comes from nuclear, and there's basically zero uranium production happening in the United States right now. Zero is an exaggeration. Energy Fuels is producing a small amount. Uranium Energy Corp is producing a very small amount with plans to ramp up. UR Energy is producing a very small, but these are all, you can consider all of their production as zero in the grand scheme of things. So the US is also entered an era now, say what you want about the current administration, and I have a lot of gripes with them, but they have pushed for domestic extraction of critical minerals, uranium being one of them. They're fast tracking some uranium mining projects, and they are looking to bring on more domestically sourced uranium. So the American uranium story is pretty interesting. I think that's pretty appealing. But overall, the sector's in such a good space. It just comes down to picking the right companies. Like I said, you've got the Sprott Physical Uranium Trust as kind of your least risky, just betting on the price of uranium. And then from there, you could go to the URNM ETF, which holds a basket of miners, and it's more heavily weighted to the big players. The Kazatomprom and the Cameco are the most heavily weighted individual companies. And then if you wanted to get into the weeds, which is uranium's the only sector where I really get into the weeds and I look for certain opportunities outside of the ETFs and the big producers. It's tough out there because I don't know how many uranium companies are listed right now, but there's only a handful of them that actually look like the ones that aren't yet producing, that look like they're going to produce in a meaningful timeline. And it's the big question, where's all this uranium going to come from? And those companies that are able to produce it, I think are going to be the benefactors of a very high uranium price.
That brings up a very interesting side question. In the past, we talked about how uranium prices didn't climb for a long time because the old Soviet Union de-escalated their nuclear warheads and used them for power.
Right.
With the current situation and our current administration wanting Iran to give up their uranium, part one of that question is, will that seriously affect the price of uranium if they get it? And two, will that make up for our deficit, our current situation where we're not producing as much?
Interesting question, but the answer is no, because it's just there's not enough material there to then turn into nuclear fuel on a commercial scale. It might end up being a drop in the bucket in the unusual event. I think Iran will never give their uranium to the US. I think Iran will never truthfully commit to not having a nuclear weapon. I mean, why would they? Again, I don't want to get too deep into geopolitics, but Israel has a nuclear weapon. So the argument that Iran shouldn't have a nuclear weapon to me doesn't make sense unless you believe they're just bloodthirsty animals who are going to start launching nukes at people the minute that they get them. Nuclear weapons are a deterrent. They're the reason why nobody's bombing North Korea right now, because they have nukes. It's the reason that, a lot of different countries are able to not get entangled in massive full-scale conflicts with certain other nations because they have nukes. They're not going to attack. So just from a logical perspective, Iran is not going to give up their nuclear weapons program. They might say they will. They might say whatever they need to say for certain concessions, and they'll do it behind the scenes. If they publicly have to state, okay, we're giving the uranium, or we're going to do this and that. Truthfully, that's not going to happen. And even if we assume the full capitulation of, guys, we're in such a bad spot, we agree to everything you demand, and we're going to give all of our uranium to you, we're going to give all of our any nuclear weapons we have under construction, or whatever they've got, it's still a drop in the bucket compared to that megatons to megawatts program you're speaking of. So basically no risk of it impacting the price of physical uranium for nuclear fuel.
Actually, I agree with you. I don't think they'll ever give up anything, and I don't think they ever intend to keep any of their promises.
No, no.
Are there any topics that you would like to cover?
Yeah, I would just say, we're in a pretty crazy time in markets. There's a lot of market manipulation going on. There's a lot of insider trading going on by the political class out in the open. I would caution people against jumping into tech stocks and AI because the political class is doing it and because it seems to go up forever. I would also encourage people who are outside of that sector to not get disheartened by continuously seeing the S&P and these big tech companies continuing to perform, stocks like Tesla, the Magnificent Seven, Nvidia, this whole AI revolution that a lot of people are being kind of conned into believing is happening. I think we will see those valuations come back to earth. That could potentially be very violent. And so I would urge people, use caution when dabbling in the broad market, and also, don't get too overwhelmed by physical metals going down, by temporary lulls in the commodities sector, because the setup is so perfect. It's years and years of underinvestment. The supply side is now so constrained on most of these commodities. So study, understand the long-term thesis. Don't get distracted by day-to-day noise. The media is moving so fast now, both social media, traditional media. They're just trying to keep you engaged to make advertising dollars. So their goal is to outrage you. Outrage sells the best. Tragedy sells the best. So you're seeing all these sensational headlines wherever you go, not because these people want to inform you about what's happening, because they want to get your attention, because that's how they make money, through advertising fees. So it's a tough era to keep your head on straight with all of this, wars going on and things happening around the world. So just focus on the fundamentals of what you hold. Focus on physical metals as the foundation, and don't get distracted by the day-to-day noise.
I totally agree with that. Your channel is going in a very interesting direction, especially with your boot camp. Would you care to tell the viewers about your channel, how it will help them, and will you allow me to put all the information that you've presented in the description below?
Yes, absolutely. So if people want to watch the bootcamp replay, it's join.jessieday.ca. Keep your eyes out for the next one. I might also be doing a community, a kind of an online course where it gets updated every month, maybe have special guests on. I'm trying to diversify outside of YouTube a little bit because, we've seen YouTube's not the same as it used to be. Let me just put it that way. And then in terms of the channel itself, yeah, weekly interviews, 2 to 3 interviews a week with some of the brightest minds in the investment space. We focus on gold and silver as kind of the main topic. We also talk about geopolitics. We talk about uranium, oil and gas, and the rest of the commodities complex as well. So you can find that by searching Commodity Culture on YouTube. And you can also follow me on X at Jesse B. Day.
Well, everyone, those are all the questions I have. Please feel free to contact Jesse at Commodity Culture. And as I said, his contact information will be in the description below. Thank you, Jesse, for coming to the channel. I can't wait to have you back again.
Me too. Looking forward to the next time we can chat, and very much appreciate you having me on.
Same here in return. Good night, everyone.